What a week we had this week. This is going to be one of those weeks where we go back in the archives and we watch the Market Outlook videos from here and we're like, man, that was quite a crazy week here. Before InvestTools got rid of our old channel, Market Forecast channel, that when I used to do these videos, we actually had all those 2008 videos archives posted too. So this is going to be one of those historical weeks that we're going to always go back and say, that was quite the period. 1 year from now, 2 years, 5 years from now, 10 years from now, we're going to look back the same way we look back at 2008, October 2008, and that was quite the memorable experience for me in the trading market. So quite the historical day, historical week. We're going to talk about it today in terms of how significantly there and what some green shoots, some positive signs that actually developed out of the last couple of days from a technical perspective, and then what we can expect going forward. Where can we expect some resistance? How much further can we expect it to go down as we retest these lows? What some long lower shadows might look like on whether it's a weekly chart or a monthly chart by the time this month is over. So we're going to break all that down in today's video and look for a stock that might be giving us a good buy opportunity here, a good solid company that in the past, when it's fallen during these last couple of bear markets we had, when this stock actually held up well until the big consolidation move where it fell off a cliff finally. Well, it's the same things happening here this week, and that might be a good idea. Might be a good time for us to look to potentially buy the stock. So I'm going to talk about buying, putting in a buy order without actually putting in the buy order and getting paid for it. And then we're also going to talk about how that might impact the broader market posture. So let's go ahead and get started. Today is Friday, March the 20th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. Really quickly, before we hit these charts, subscribe to our YouTube channel by mousing over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below this if you're watching us on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells me two things. Number one, you liked the video today. Number two, you want us to do it again Monday. So a quick way to give us feedback. If you don't want us to do these videos anymore, then don't click on anything down there. And also while you're down there, comment, what did you get out of our videos today? As people come and check it out for the first time, they read through the comments to see why they should watch and let them know what you got out of it. Join our website at MarketScholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between these videos from day to day. In fact, you can like today's Market Outlook tweet there, pinned to the top of my timeline. The more you engage with us on social media, the more those platforms will push our content to you. So that's how you can make sure you get our stuff. You can also join our Market Outlook Facebook group that we've created. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the long lower shadow we had on Thursday, we traded towards and inside of that long lower shadow. Remember, the low point is a support level when you get those, and we still haven't closed up above. I mean, that was a hammer pattern that still isn't a reversal pattern yet until we close up above it. And so now we've had a couple of days with similar highs to keep an eye on. But again, we've seen before, and we've talked about before, long lower shadows, you can still trade within the range of those long lower shadows. It's that low point on a closing basis that can act as a support level. The near-term line now has been below 50 this whole time. Interestingly enough, this was the day right here, and this gets, I've seen some people talk about it right here actually. This was the day that the oil, this was the Monday, and over that weekend, crude oil dropped sharply because of the price war between Saudi Arabia and Russia. And I think that gets a lot of credit, or should get a lot of credit for how bearish we've been on this leg lower, is that tumble. And the reason why it comes to mind is crude oil tumbled today from its high of the day. We're here at $28. We tumbled all the way down to $22. So we lost $6 in one day from high to low. That's about a 25% drop on a $28 stock. That's a tremendous move. I mean, you look at the range today with 6 points. That's a huge range. Again, the high to low. So a pretty tremendous move off of that high point. And another reason why we sold off, or probably one of the main reasons. So again, here's here's that March 9th. So we were already pretty bearish and some speculation going into that meeting, that emergency meeting that was held over the weekend. People sold crude oil off in anticipation of that. And then boom. So you can kind of see, as bearish as we were, and we were getting some clusters and things were looking bad, but things really hit the fan because, again, from that point, from the if you look at the asset class comparison here, you look at March if I come out here, March the 9th, when we opened up that weekend, all the way up till now, we'll go to a 15-minute chart. So crude oil gap down, and you can see it has been down now. At one point, it was down 50% from the close on the 6th, where it was already down pretty significantly. In fact, here, let me detach and let me see. By the time that we had actually peaked on crude oil, it was actually, we got the light green shading in the yellow line pretty much on February the 21st, February the 20th. So kind of show you, this is where the stock market peaked, right? This is where the stock market, these first 2 days, the 20th and 21st, were the down days in the stock market. If I were to do a little comparison here with the S&P 500. Jeez. There we go, comparison. With the S&P 500 again, you see that's where the stock market peaked. See, we were already diverging up until that point. By the time of that point, we got the bearish pattern. Didn't get the yellow line, but you got about as close as you could get. Of course, nobody predicted that we would be down 50%. Again, from that level right there, we're down 50% at that low point from the close. But if you go to February the 20th. On this, so February the 20th, you can see crude oil was actually down 60% at its low point. So we were already down by the time we hit February the 20th. When stocks fell 15%, crude oil fell 15% too, and then again it fell 50% from this spot, right? From that low point to this low was a 50% decline in crude oil. And you can see at one point, we were down 15%, and we had hit the lows. We were kind of retesting those lows, and then crude oil is what made us come down from a 15% loss to a 32% loss from that close. And again, but that's not where crude oil peaked, right? Crude oil actually peaked on a closing basis. We hit 63.04 there. So this was our highest close that we had on January the 3rd. So all the way back to the very beginning of the year, and there was some chatter about the coronavirus at the beginning of the year in January. But you can see here the sharp declines. I mean, by the time we got to, before we hit that February 20th high, crude oil had itself dropped about 20%, practically 20%. And then it had bounced up and hit that nice low on the February 20th highs on equities, and then we rolled over. And you can see as crude oil was falling, real estate and gold, and the long-term bonds, and the dollar for that matter, were all rising. So they were all rising while everything else was falling except for the S&P 500, those FANG stocks leading us up on that last leg. And remember all those million divergences that we've talked about. Then that at least told us we were headed towards an intermediate pullback, and that's kind of what we were looking for here at the beginning. Of course, it turned into expectations for a market sentiment pullback, and then a death cross, and then an extended death cross, and now is this 1929 all over again? It's kind of come in waves, but a lot of those waves have occurred because of crude oil being down as much, being down 61% here at its worst, being down 65%. From its highs that it had back at the very, very beginning of the year. So just going year to date here, here's our year to date. So, stocks are down 29%. S&P, is down 29%. Small cap stocks are down 38%. Gold is down 2%, and long-term bonds are up 18%. So, that's a pretty sharp year to date return. And again, most of it coming in March. So here's March. Here's where we are at, just this 1 month. And that's kind of what I brought up on Twitter is, eventually, you've got, this is the month return. So we started March okay, coming off of a low, and then we've really fallen down, being down 22% just this month alone since the close on February. And you can see until today, long-term bonds were also down for the month. The only thing that was up on the month was the dollar and this little rally it's had. Crude oil down 50% this month. Small cap stocks down 30% this month. Real estate down 30% this month, 31%, in all these developed markets. So a really, really bad month. And from a monthly perspective, when you look at the S&P 500 here on a monthly chart, you can see, in fact, all the other months that have been down this much or more on a percentage basis have all finished with a long lower shadow, which means we come off of the lows for the month. Obviously, you have extremely low short-term sentiment that we haven't had. The near term line is at a lowest point. Now it will move as if we move up, it will move up too. But you can see it never got this low during either one of these last recessions. So, which tells me not that this is so much worse than what we had in these two recessions. It is a pretty bad month. But what it tells me even more is that, here's a log scale, so it puts it a little bit in better perspective. So, you can see when you look at it there to there, right, that October was a pretty bad month when we were at the low, right? This July was a pretty bad month when we were at the low point, right? So here, let me just snap it, make sure it's snapping. The open, high, low, and close. So whenever I snap it, so this is October right there. So when I snap it from close to low, we were down 28% from the close of September to the October low point, and then we bounced. On this month here, from October to November, to the November low point, we were down 24% at the low before finishing down 8%. If I go back to this July, this really bad July month, right? So that ended that bear market there, and we retested inside the long lower shadow. See, we can trade within the range of the long lower shadow. But on that low point, at one point in time, we were down 21% before finishing the month only down 8%. Come over here to September the 11th, right? Here we go. So finish right there, down to the low. We were down 16% before finishing the month only down 7.5%. And yes, things are bad now. They're bad. Things were really bad in September of 2001 too. The economy didn't shut down for weeks, but it shut down for a week. As this, not necessarily not the whole economy, but obviously the travel industry shut down for that week at least. But in September here, the financial system was on the verge of breakdown, like severe breakdown. And we finished off the lows of both these months here, and then traded within the range of both those long lower shadows before closing above those lows. You can see even November, we closed above the low of that month before we got that new long lower shadow that we traded around and in there. So same thing with that long lower shadow. And then of course, the common comparison that we've been making here lately is to 1987, right? Go to a monthly chart on that, and zoom in. Gotta fit the studies. There we go. So zoom in on 1987, and then there's the month there, right? The long lower shadow. See, at the end of that month, at the low, we were down 32%, 32.75% for the month before, and that was at the bottom of Black Friday. Before we finished the month, only down 21, only quote unquote only down 21%. You see, the next couple of months we traded in the range of that lower shadow, even though we set the low point there. And you can see other examples. Here's March of 1980. Here's the low point of 82 when things really got bad. We traded within that range still, and then we rallied. So that's kind of why I say on March 31st, don't be surprised if we don't end up with a long lower shadow here. And we talked about in technical analysis today where that can get up to. The expectation being that it could get up to right here. Getting up to at least that 17-day moving average, if not the 30. See, that 30-day moving average, you know, it's not going to happen in a day. Let me get rid of these lines, this one and this one. If you look at this, if we bounce here, we're not going to bounce up to like the 30-day moving average in one day. And you notice the 30-day moving average has gone from 302.79 to 299. So that's a 3-point drop here, 3.5-point drop. Expect it to continue to dropping at an even faster pace because we're so far below here. So expect it to keep dropping. So by the time we hit it, there's a good chance, if we hit it, there's a good chance we hit it right around this 280, right? I mean, it can, if you kind of draw the same line, kind of go at the same pace. And obviously it's going to go in a little bit because we're down below it. So it's probably going to be like this. So here's 280 right there. So let's come down a little bit more. 280. Right there. And move it right. Okay. So there's 280, right? And that's where there's some volume support right off the Bollinger Bands. That's where the volume, if you notice here, right there, the 280 is where it starts, and then it works its way up to about basically 290. That's on that basis. If you look at it on the intraday basis, on the 4-week chart, there's 280 right there. So it's going to hit this volume node and then potentially up to that volume node. Basically fill in some gaps, fill in that gap, fill in that gap. We've talked about these gaps, right? And then maybe fill in these two gaps, maybe. Most likely fill in this gap and maybe get up to this midpoint too, where the 280 level is. So if that happens, sorry, here's my tweet deck here. If that happens, let's get back to, where is that line I just drew? So it's going to be on the 3 green arrow chart. Okay, so there it is. So that's where that volume node is. That is on 326. So that would be next Thursday, right? If we rally up to that point. And to get to that point, to kind of give you an idea, if this is the low point that we just closed on Friday, and that's pretty, to close a week at the low is pretty significant. You know, that would be a 22% rally to get to that point, to get to 280. Now, I don't think we'll finish the month there because there's still 326. You know, we still have, we would still have a few days left in the month, a few trading sessions left in the month. And even if we end up, even if we, let's see, here's 228. So we close 228 right there. So if we end up closing there, that would only be a 6% drop for the monthly candle. So most likely if we hit up there, we'll probably come back down towards this level in those next few days. If you get up there next week, you know, you're going to see me, especially from a directional option standpoint, really put a lot of negative delta trades on our portfolio, to take advantage of the subsequent retest of those lows. Because I remember on some of these other charts occurred over a couple of months. So that we're talking like April and May that we could retest in this area. Again, if you go back to that November, of 2008. So I go back all the way over here to 2008 and see how so at the end of November, remember we traded months within that range. So right in here, and I have to keep doing this. I keep forgetting that I just should save it like that, but sorry, don't want it to show high and low. There we go. So here's the November. There's the low point in November. So you can see after we got to the end of November, we closed up here. So right there is where we finished November. So you see how in December, so there's the long lower shadow right here. So in December, you see how we traded up and in it. In January, we're in the range of that long lower shadow. And then in December, we came down, or February, we still traded within that long lower shadow and flirted with closing right below it there, right here, actually. And then by March, we went down below and finished up above that long lower shadow. So that, that sets the low point, and that came after this low point. And we taught today in class, had you thought, what, in October of 2008, that was the low. Like, there's no way, that was such a bad week, and Lehman collapsed, and we finished with this is a daily chart. So on the weekly, so that's a Friday. So that's a daily, that's a long lower shadow on the daily chart, but it's also a long lower shadow on the weekly chart that you can see we traded within the range of that very next couple weeks for a while here before popping right back up. So you can see how long lower shadows get filled in, or we trade in the range of those, and they hold for support on a closing basis, mind you. But the idea that, let's say you thought that was the low point, maybe like this week, this has got to be the low point. We bounce back up. It's Black Monday. This is Black, March week, really bad week. I mean, March Madness. It was March Sadness. So this is the week March Madness was supposed to start. So it's March Sadness for a variety of reasons. That's probably why the stock market's shutting down, because there's no NCAA tournament. That's the problem. But had you bought there and thought that's the low point, because that's the discussion today. Well, this is not the low point. Nobody should be buying stocks. They're idiots that are buying stocks right now, blah, 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 blah. But the idea is, had you bought there, you'd been down 25% right there. And by March, from that close, you would have, if that was your zero, you bought the S&P 500 itself right there. By that March low point, you're down a quarter of its value. But a year later, exactly 1 year later from that date, despite the fact that you started with, from October to March, so that's November, December, January, February, March, 5 months. Even though you started the first 5 out of 12 months with a 25% loss, the gains you had the next 7 months would have given you a 12-month return from that date of 19% to the upside, even though you started with a 25% drop. So this idea, like trying to find the low point, if you're looking for returns by next week, it's very important that you try to find the low point, and I will say it's practically impossible. But if you're looking at, what's going to happen March 20th of 2021? Where's the market going to be? When you look back at March 20th, it's not going to matter, right? I mean, yes, your returns on a year basis would be better had you got in there, and it would have been a lot better had you gotten in there. But nobody knows where those lows are. It's still 19%. It's still a really good return. And then, like I said, if you go out further, 5-year returns and up to 10-year returns, your 10-year returns from that point was about, 24% a year for 10 years was the return you got. And that was with 2018, the back end. We were dropping at the back end because that was Q4 of 2018. We were dropping pretty hard. So we had a 25% drop to begin with, a pretty steep drop to end that 10-year period, and you still netted a 24% a year on average return had you bought there. So it doesn't matter. 5 years from, 1 year from now, 5 years from now, 10 years from now, it's not going to matter whether today is a low, if next week's going to be the low, or if 5 months from now is going to be the low point. All that matters is, this coordinated fiscal and monetary and global efforts that we have going on, in addition to extremely low borrowing costs and extremely low commodity costs. Inflation is what caused this. We had really, really high inflation in 2008. This is right here in 2008, commodity prices were shooting to the moon. Inflation levels were relatively high at that point. By here, obviously, they had all fallen. So that's the question is, are we starting or are we ending? And in my opinion, and I've been stating this for a while, and especially in my classes, I believe that we've been in a recession since January of 2018, but especially since October of 2018. And now we are in the process of actually ending, like we did in October of 2008, like we did in July of 2002. This is the process of ending, the blowout process of ending that bear market. Just to kind of give you an idea, this is from October the 3rd of 2018. So that's when we started that's when we really fell off the cliff, right? I think that was the beginning. Especially, even more so. From an international basis, it started in January. But here in the U.S., you can see it really started in October of 2018. We had that Q4. It really fell off a cliff. We rallied up. That's when I think things really fell off the cliff here. You can see crude oil fell 40% from those highs. Small cap stocks were down 20%. The large cap stocks were close to 20% drop. People said we were in a, that was a bear market. No, that started one. And you can see by the time we got over to this point, to this September, when we were coming up off this October low point that I actually thought was the low point that we're going to be coming off of without getting this blowout. Well, we didn't. We weren't able to finish that market sentiment decline without this blowout. The market sentiment line on the market forecast never pulled down below 50 here. It did on the Russell because the Russell was down 11%, but it didn't pull down below 50 on the market, on the S&P until now. This is the blow off bottom of the bear market that started back here. That only we don't think was a bear market because of those mega cap, large cap technology stocks that led us up to these highs, even while real estate and long-term bonds and gold were at extreme highs because the market was in safety mode this whole time. And you can see small cap stocks at their best, it was only up 2% off of those highs, and then you can see the pullback. So that's why I think there's a lot of similarities now to 2008 to then. From that perspective, as a finish to a bear market, I think there's a lot of similarities there because I believe that we were in a stealth bear market. So now, granted, there's a lot of similarities in 1929, 1987 because of this, the long-term chart not giving us a death cross until the worst week, right? And we're getting the death cross now this week, this down week, just like we saw in 1987. It was actually the week after in 1987, and just like we saw in 1929, we got the death cross on the bad week, and then we came off the lows and retested the 200-day moving average over the course of the next few months. I believe it was May of 1930 that we hit the moving average, and then it was like I believe it was May 1988 when we hit the 200-day moving average. The difference between the two is in 1988 we made it back above and stayed above. In 1930 we got above it, and then the very next week came back below and never got back above it. So that's the big difference between the Great Depression and what was just a really bad Black Monday. That will be, that up to this point was probably the worst short-term period ever, and this is coming really darn close to being one of the biggest drops. Even if you just look at these 20 days, right? If I go to a rate of change now, just to compare the rate of change now to that 1987 period on a 20-day basis, right? So we're just gonna go this last four, so it doesn't include those first two small down days that we had before the week ended. So here's a 20-day, 30% down move in 20 days. And for some perspective on how significant that is, if I were to come over to 2008, during that period, we never did hit 30. We came close at 28. We never did hit 30. That's how significant this selling is. You come to 2002, we didn't even get to 20, in July of 2002, or in September 11th. Now keep in mind, September 11th we closed for a week, but we never did hit it there either. Here's 1987, and in 1987 we got to 29.5%. Was the worst 20-day period that included this selling, 29.5%. And then going all the way back to the Great Depression, the down move that started that, we were down 35%. At the very worst of it, we were down 23, 24%, and then we bounced up briefly and then came right back down. The worst was 35, and then you can see we rallied. We had a big 20-day rally of about 20+%. 22%. We had a 20-day rally of 22% off of that low point. So when I say, we rally off to that 30-day moving average, we've seen it. We've seen this happen before. I mean, look over here. You had a 70% rally in 20 days coming off of that low point in 1932 when it was at the worst there. But here we are, and here's some other 30% declines, well within the bear market. Here we are at 30%, 30.94. So, good signs that we are slowing down. In fact, if you look at some of these other signs that we may be slowing down here, besides the fact that you're getting divergences out the wazoo, but you also see that you have the, the ATR as a relative basis is kind of starting to slow down. We ended up with a slightly higher than average. Before that last little crude oil induced sell-off at the end of the day, to kind of finish at the low of the week, we had a below average, and we had a slightly below average range on SPX yesterday. So we're just barely above average now. You can see the ATR is kind of flattening out here. That's a very, very good sign that things may be slowing down. The other good sign that things may be slowing down is that implied volatility didn't rise with this downward move. In fact, it fell today. In fact, it stayed. Not only did it fall with historical volatility kind of flattening out, and you can see, look at the small red candles getting smaller. Good sign that they're not getting bigger anymore, that they're now getting smaller. So not only is implied volatility falling, the VIX falling compared to historical realized volatility, but it's also falling compared to the back month volatility. You can see this week here, if I just go to a weekly chart, there's the week and long upper shadows, but look what happened to the back month. Big drop in the VIX compared to the back month. And a good sign there too that things are settling down. Long upper shadows, and there's definitely going to be a long upper shadow potentially on the monthly chart. You can see that's the October monthly chart, the long upper shadow, and a couple of months later volatility had dropped all the way back down to the neutral zone before the retest. So you can kind of see some green shoots forming on the S&P 500. Not to mention, as I mentioned yesterday, the MACD rising, right? There's the volume rising, another day of 1.5 times the average volume, some extreme volume. In fact, there's your weekly. Look at those 2 weeks of just extreme volume versus the 1 week we had back here. Here, let me do this. Let me do price access, and we will do not fit the studies and not fit the high and low and use log scale. All right, so now then I want to come and let's just get rid of the MACD and stochastics for now so I can see this volume chart down there. And I'm actually going to bring up the volume chart. All right, so here's the volume chart here, and you can see the weekly volume on a 5-year basis hit 5 standard deviations from its norm. 2 weeks in a row of 5 standard deviations of volume from what it normally sold. If I go back to the 10-year or 15 years to include that 2008, you can see how much volume we had over there. And remember, that volume over there, as high as it was at a much lower price. So lots of money compared to right now. But here you can see, here's August of 2015, big, and you can see a big amount of volume here in August of 2011, also at a lower price than we're at. So that's why, again, when you look at, say, 2011, and of course there was, if you look at the amount of money, the volume here on this was 2.973, and let's just close it. Let's multiply it by the closing price, so 118.12. So that's a volume flow of about $351 billion. $351 billion. So to kind of give you some context on how much money moved this week, because it's not very much volume, right? Well, let's take a look over here. So move this all the way over. We had 1.52. So is that right? Was it 2.9 over here? Yeah, 2.8. Excuse me, 2.973. Okay, that 118.12. All right, so let's come back over here, and we are at was it 1.5 sorry, it's the wrong number. It's this number right here. So it is, because the purple line was 2.9. So 2,884, 411, 110 multiplied by 118, the closing price. So $341 billion. So $10 billion less. Now let's compare that to what we see here, which is 1,523, 388, 460. Has how many shares traded, and then today's close, this week's close, which happened to be at the very low, so it's actually trading more money. This happened to be the very low close. $348 billion. So very similar, even though much less volume. You can see the money, and obviously we had more money than that because 228.80 we only barely touched at the very end of the week. Most of it was up here in this you can see the midpoint of this area. In fact, you could say, if I were to use a Hakinyashi instead to give us a midpoint, kind of an average, you can see it would be 238.73. So another $10 times, $10 times per share times this 100, so we're looking at another, what would that be? 1.5. Ends up being 363 billion. So more money traded hands today, and we've had 2 weeks of this. Lots of money trading hands these 2 days. Big standard deviations, even though it doesn't show here, but on the 5-year basis you can see how big it was, and of course on a 1-year basis even that much more, right? You just don't even see it on the 1-year basis here. You can see that there's the standard deviation there. The big, huge climb in volume here, big extreme amount of volume these past 2 weeks. When people say we just haven't seen the consolidation type of volume, yeah, we've seen a lot of volume. The biggest amount of volume that we saw here in October was 3.2 million shares. So to kind of give you an idea of how much money traded hands that day. So, the Hakinyashi close was at 96.71. 96.71 times the 3,283,097,760. So we had 317. So as bad as it got there, it wasn't even close. I mean, we traded more money this week and last week by themselves more than what we had there. And we were at 360. What did we say? 363. Yeah. So that should give you an idea of just how much money has flowed through this week. It's a big consolidation type move here, even though you might not think that way because the volume's not as big as it was back there. You look at this and you say, man, we haven't had nearly as much volume as we had back there. The price is also a lot higher now than it was back there too, and that's the other consideration there. So another sign that we are in the process of ending this bear market like we were there and like we were in July of 02. And you can see how much volume we had there. Very, very extremely little volume there that we had. And we have a lot more volume now than even then. And the price was way low. So lots more money. So much more opportunities here. And you can even see by the time we got over here, a lot less volume formed that March low point. That the big move was in October, and that's the big move we're seeing now. Now again, in October, we didn't set that low point. As I showed you, we got up to the 30-day moving average here, and then we rolled over, and then eventually we got to, so you can see, I mean, we tested the 17-day right off the bat. After that Friday, really bad Friday, we tested the 17-day right off the bat, failed, came down, traded within that range, got to the 30-day and failed before we tested that new low point. Then we started to figure out and get around the 30-day. We had one last leg lower. We got above, then we never came back down. We started to work our way towards the 200-day at that point. You can see the 200-day move in 2008 over here to the right. So that, the 200-day, once we got up to March, so this was March here, and we got above the 30-day way over here when we were testing the 50, we got above the 30-day moving average. We didn't hit until June, the 200-day, and we failed initially there before July of 2009. We got above it, and then the week later we stayed above it, And then a couple weeks later than that, we got the Golden Cross. And from that point, it was full bore ahead all the way up until now. So, and now we are at the, from that low point, we are at the 38% Fibonacci retracement level. So we are at some significant support here. We are at some significant support from that low point all the way up to this high point. All the way up to there, you can see we're pretty much at that 38% Fibonacci line. If I can, I don't really have my lines drawn as perfect as they should be. So there. And then if I zoom out to over here, move that up to that low point. All right. So you can see now how we are flirting with this 30-day moving average. Get to the price, go back to auto. That 38% moving average there. We'll see how we end up next week, right? And how we end up this month if we end up with the long lower shadow. And why that's a really important level that we finish. You know, if this is a, remember, we got, this is a whole Fibonacci retracement zone. And I mentioned to people before, you know, if we're going to go lower to a lower low like we did in November of 09, or 08, excuse me, after that October week, we went to a lower low in November. If we do that, this is where it's going to be. There's a big volume node right here on that long-term chart. Big volume node that will hold us up in that area right there, 208 level. So if we're going to get to a lower low, that's another, you know, what, however much, 12, 16, 12, 15% lower from there. After we potentially bounce back up to wherever, 280, you can see would be that volume node. We bounce back up to that volume node, then potentially roll back down to that level. As quarterly reports start coming out and the market starts, you know, pricing in the impact of a negative, you know, hugely negative quarter of GDP and all that will most likely get us down to there. But the market's already expecting all that. If you're not expecting that, you got your head in the sand. Those types of numbers. So you know, once the market says, okay, we've already got that price in, so buy the rumor, sell the news type of phenomenon, then we'll be able to do what happened in March of 09 and start to work our way up. But keep in mind, that was 5 months after that first bad week in October that we basically are experiencing this last couple of weeks, last week and this week. All right, so for our trade idea of the day, I wanted to take a look at a stock here that is hitting some pretty significant long-term support, and that is PepsiCo. In fact, this is the 5-year chart. If you take a look at its 10-year chart, you can see where there's some significant support here in this area, right around 105 to 100. You can see if let me get rid of this, get rid of the probability of expiring code. You can see it better. There we go. So right in this area, 108 down to this 105, 100 area. In fact, it kind of came down a little bit while we were talking during our Market Outlook live session. So significantly bearish week, coming down to significant support, even down to 100, big round number there at 100. Big jump in the Bollinger Bandwidth. It's not, obviously it's not going to be done because we just barely started, right? It just barely jumped up to the upside, closing significantly below. In fact, on a weekly basis, if you look at that close, in terms of being below the moving average, you can see we got down there in October 2008. There's that big down week it had then, kind of set the low point there. Significant. That's probably where the Bollinger Bandwidth will end up once it's all said and done. By the time we get to this point, but you can see, I mean, we're down further now, and then there's 2002, July of 2002, and the bear market ended there, right? So these are the end of bear markets, or the other times that we dropped this far below the lower Bollinger Band, and you can see that kind of set the low. Went down a little bit lower eventually a few months later in that March of 09, but you get the idea here. So I mean, that's a significant downturn. There's a lot of support in that area, and that 5-year chart and that 10-year chart. If you look at obviously the daily chart for Pepsi, I mean, the oversold cluster, which we don't get very often on a stock like this. Getting an oversold cluster is actually rather significant. In fact, we just barely on on Valentine's Day, mind you, we just barely had an overbought cluster. So getting an oversold cluster there, obviously not yet on the weekly chart, but you notice we did get an oversold momentum line on the weekly chart that did not drop below the 5th percentile. So the intermediate line falling here below the 50% level, the near-term line not dipping down. So very, very oversold short-term sentiment, long upper shadow. If you take a look at its DMI, you can see the extreme moves the DMI has had. Let me pull this up here. There's the, actually started out with the extreme move over here in the end of February. That was an extreme move as it was, and you can see we've been progressively getting lower and lower. And while the high, the directional minus index is actually getting lower, and the ADX itself is back to an extreme high point itself again. Very significantly extreme moves. Here's the weekly chart on the DMI, and you can see it's also to an extreme, up above 40, down below 10. I mean, for that to happen, this is the last time that happened, where you got actually just above 35 and below 10, and then over here you got way above 40 because you had that long lower shadow, and we didn't drop below 10 there. If I were to go back further to those same 2008, 2009 time frames, we got above 40. We did not get below 10. We eventually got below 10, and that set the low point. Here we got above 40, and we got below 10, and that set the low point. So kind of more similar to this July 2002 low point. So you can kind of see, again, we're kind of looking like the end of a bear market rather than the beginning of a bear market. And when you've got like companies like this selling off sharply, you can see during the rest of this bear market, Pepsi didn't really sell off sharply. It was actually kind of holding up really well here in September of 2008. But when it dropped as much as it did, and same thing, all the way in during this recession, all the way up until July of 2002, even during September 9/11, it was doing okay, way over here. So, but when a company like Pepsi joins the party and we really fall off a cliff, then that's when the falling off a cliff is the brunt. We've gone through the brunt of it. That happens to be this week. So we can say, okay, well, let's see if we can put in a buy limit order, but get paid for it on the stock. So we'll come in to look to sell a put either at the 105 or the 100. We can sell the 100 put. Depending upon where you end up getting filled in, you can get filled in anywhere in this area. Let's say you get filled in like at $4, right in between here. So that's almost $400 credit. The buying power is actually a little bit high right now because we're after hours trading. It was actually a lot less than that when in fact, sorry, I'm in the IRA account, that's why. So here we go. Let's do it this way, and you can see what it is in the margin account. $1,700. So about a 25% to 30% return on risk to put in a limit order to buy the stock at 100. And if the stock drops, I've got about $4 down to 96. Remember, there's very, very strong support on the chart in this area on a long-term basis. So an opportunity for us to be able to take advantage of that, move and buy the stock. Get paid $400 essentially, or 25% of the capital. And if the stock rallies off of this and we don't buy it at 100, then we'll just look to do some other type of trade on it, right? We can trend trade it eventually when it get the 3 green arrows or the light green shading and the green line. But at least we can say, okay, if it dips below but we hold support by the time it's all said and done, then if I end up buying the shares at 100 and I get paid $400 to do that, I've got a new cost basis down below that support. Everything would actually be pretty good there. Well, all right. Well, that does it for today. You've heard from me. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen to go to our Market Outlook forums. Open up any new thread there, and let's keep this conversation going about what happened in the markets this week and what we can look for next week. Again, thank you for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon down below. Comment on our video. Follow me on Twitter. Like today's Market Outlook tweet on Twitter. Also join our Market Outlook Facebook group and like our Facebook Market Outlook Facebook post there as well. That way you can make sure those platforms continue to push our content to you. Have a great rest of your weekend, everybody, and we'll see you all next time.